Grüß Gott and welcome. Maybe I haven't been here, wasn't here yesterday, but I guess some of you have certainly already been to the Oktoberfest. Some of you may probably return there, maybe later tonight or over the weekend. And as you head there, chances are that some of you will still be looking for a souvenir for family back home. If you're not too familiar with the Munich Oktoberfest, actually the quintessential Oktoberfest souvenir is not beer. It's something arguably a bit more civilized and certainly a lot more transportable. It's gingerbread hearts, or Lebkuchenherzen in German. Now, as you look for the perfect gingerbread heart for your family and loved ones, sorry, I'm not doing very well with the mic here, you're probably gonna ask yourself, you're going to ask yourself which one to pick. As you stroll over the Oktoberfest, you'll find stands that sell them in all possible forms, designs, shapes, textures, and really even flavors. And depending on whether you're looking something for maybe a little boy who loves chocolate or marzipan and likes, soft texture in his Lebkuchen, or if you're looking for something huge and maybe gluten-free to say, hey, sorry guys, I forgot your birthday last week, something along these lines, you're going to come up with a very different Lebkuchenherz that you're going to buy. I, for myself, actually what I'm going to take home tonight for my husband is this one. It's an FC Bayern Mir san mir Lebkuchenherz, because he's Swiss and he's sort of on a trajectory to becoming a bit more of an FC Bayern Munich fan, but he's not quite there yet, and I'm going to help him. So, why am I telling you all this? So, for once, I'm born and raised in Munich, and being here at this time of the year, I couldn't help but slide in something about the Munich Oktoberfest. But a lot more importantly, the way you pick your perfect Lebkuchenherz with the perfect texture, the perfect recipe for your loved ones back home that you know really well, whose hobbies, preferences, food allergies, whatever it is you know really well, is very similar to how an investment manager finds the perfect smart beta strategy for their clients whose philosophy and whose portfolio they know very well.
So launching a new strategy or a new ETF strategy at an asset manager comes with challenges and comes with considerations very similar to trying to pick out a souvenir at Oktoberfest. So things that you need to evaluate, and typically where we start is, are we launching something to address a client's concern today, or are we actually trying to project out into the future? And projecting out into the future takes a level of foresight, and it takes patience. Are we actually trying to solve a problem that doesn't exist yet? Is it regulatory changes? Is it market evolution? Is it a potential opening of a new market? But what we want to talk about today is immediate concerns. So clients that want a strategy, and we're balancing investment merit and commercial viability. So how do we balance those two? And how do we bring in client demand when thinking about launching a strategy? And does it actually make sense for that end investor? So I want to introduce Angelika Bolliger. She's head of market development at STOXX, tasked with smart beta design and interfacing directly with clients around that design. Formerly a portfolio manager within a hedge fund specific to alternative beta. So really relevant here today.
And to my right, we have Todd Mathias with iShares, who's, as mentioned, is global product strategies for the firm. He's based out of London, covering clients, especially throughout Europe. In a prior life, he was at the different side of things, picking active managers across asset classes for one of the large US consultants. And with that, let me hand back to Todd.
That's right. All right, so we actually want to bring in a real-life case study, something that actually happened. I made a couple small modifications to protect the client's confidentiality. But we want to bring this to life, and we want to actually show how does an ETF provider and an asset manager partner with a client, but also partner with an index provider to provide a robust and thoughtful solution. So let's start with who was this client. So if we think about who the client was, they were an ETF strategist, or some may consider them a boutique asset manager. So they utilize ETFs, they utilize active product, they utilize single stocks in creating multi-asset strategies and many multi-asset strategies. The client was $10 billion in assets, and they had a challenge. And what that challenge was, they were running a single stock portfolio, and this single stock portfolio had an income and quality tilt. It was very cumbersome and very challenging to run this alongside ETFs and active managers. It was expensive, but the biggest challenge was how did they manage flow? So they would get new money in, but they couldn't necessarily allocate it proportionally across all securities. They won small accounts, they might not get exposure that they could consistently across others. So they actually wanted an ETF. They wanted a way to embody their philosophy, the way they pick stocks within an ETF. And this would be a rules-based strategy, very similar to how they pick securities with this income and quality tilt. So where did we start? So we started by trying to understand what do they do? How can we then transport that philosophy and that process into something that's, again, easy to replicate, transparent, with that similar concept that embodies the philosophy of that firm. So we gathered their securities, we gathered their process, we talked with the portfolio managers at that firm, and we wanted to understand what do they do and how do they do it. And that's again, the starting point. So we looked at their universe. Starting place was broad liquid market, so let's call it STOXX 600, covering Europe. Then we looked at, what do they do first? So because this was an income-tilted portfolio, typically driven for a wealth audience, they look at yield. Very simple screen. They're just looking at, I need a yield that pays 1.5 times the market. What else did they do? So they also looked at some valuations. They wanted to buy cheap stocks that they were going to hope get expensive, very similar to everything we discussed yesterday. And they also had a quality tilt. Very simple screens, just looking at ROE. So what we did, and then lastly, they actually did have some level of tracking error. So they wanted to make sure that it wasn't so deviant away from a specific benchmark. So we gathered all these screens, we gathered their securities, and we evaluated it internally within BlackRock. So we modeled it out. We looked, where are they taking sector bets? What type of characteristics, fundamental characteristics, does it exhibit? And is there a way to replicate that? And that's where that partnership starts. So we can understand what it looks and feels like today, but what is it going to do going forward, and how did it look historically? And is there a way to build this into an index? Or is there an index that exists currently that we could potentially launch a strategy that then would make their process and their lives much easier within that ETF house? So that's where it started. Is we went to a couple different index providers. We said, what's available today? And then can we actually just create something that's just right off the shelf? And that's not always the case. The case is very similar to baking something, right? You have to test, and you have to learn, and you have to understand what happens when I change things.
So this is where now the strategy specialist work comes in sense of saying, look, how do we take these basic ingredients, these inputs, ingredients, put them together for the perfect recipe for the client? And when you put together such a recipe, the very first thing in any passive strategy you're going to take a look at is always going to be the universe. Apologies for my mic here. I'm not doing very well, as I mentioned. Very first question is always the starting universe. So here we were looking for a European strategy that didn't per se have a cap bias. So the natural choice is a broad yet liquid European benchmark as base universe, and we took the Europe 600 here. Now, as Todd pointed out, the most important focus of this product was to be a yield focus, an income focus. And the inputs that we had gotten was the active manager that we're targeting to replace is seeking to invest in stocks that yield at least 1.5 times the market's yield. Now, when we enter discussions with clients on the question, so what is market yield? We got to make sure that we're on the same page and use the same definition and understand each other right. One, maybe the most simple assumption in terms of what market yield could be is just looking at today's yield. If you look at what the yield you can achieve in the Europe 600, in the European universe today, you're looking at roughly 3%, 1.5 times that, 1.5 times this type of market yield would yield you a 4.5% threshold. And applying that to your base universe over time would yield you the number of qualifying components shown on this chart. What this shows is that using a fixed threshold, a fixed definition of market yield, you would end up with the most concentrated portfolio of just a mere 30 qualifying stocks at the very time that the market is at its most heated. So that's not something that's typically a desirable feature, and we also agreed that this is not something that was applicable here. Now, instead of taking some sort of a fixed number and just making the assumption that the yield is stable over time, which clearly it is not, the alternative route and the route that we typically go with clients is that we look at the base universe and look at the components of that base universe at any point in time and look at the distributions of the fundamental characteristic, in this case yield, that we're looking at a given point in time. Looking at what's market for, in this case, the STOXX Europe 600 market yield over time, you can take different types of averages. So shown in the dark blue line here, you see the simple average yield over time, maybe the most intuitive measure. Sometimes it's a good solution, especially if you need to explain it to a client who likes and is very focused on having a simple and intuitive explanation, maybe to pass on to the end investor. But it also has the clear downside of being a simple average on a very skewed distribution, which means that outlier is going to impact your outcome quite a bit. What here, the spike in March 2009 actually is strongly influenced by Allied Irish banks, which paid an 8% dividend yield in 2008 and then tanked by over 90%, which comes up to over 300% nominal dividend yield at that point in time, which is not going to help you in terms of having a meaningful average as measure to use for the qualification of market yield. The next line, the weighted average, the cap-weighted average, is another alternative. And arguably, from the standpoint of an investor, that's a very relevant one. It's, for instance, the average that we use, yield definition we use for any cap-weighted indices in our fact sheet, simply because that's the yield that you're going to actually earn as an investor. Now, once again, you are not truncating the outliers, but since all these cases, such as the Allied Irish banks of this world, they're going to have such a low market valuation, otherwise you're not going to end up with this kind of distorted yield, that they're really not going to influence things much. So that's already an advantage. What is maybe not so ideal is the fact that it doesn't tie to a percentile of the market. It's not, doesn't yield you a fixed number of qualifying components. And what we also see on this chart is that it's substantially higher than the median, meaning that the number of what truncates the set of yield observed in the universe in two. And that's so because large caps who have established business models have the luxury of being able to pay out a lot more systematically to their investors than small caps are, who need to reinvest into their business models. So while we're looking for a strategy that is all-cap strategy and doesn't have a huge large-cap bias, we should probably not use a measure, and we didn't use a measure that strongly introduces another large-cap bias, which makes median a pretty good measure of what market is. But really what the client asked us to do wasn't to define market yield, but really define 1.5 times the market yield. And what we see now on this chart is we see on the top the same yield chart again as we had on the prior slide, just multiplied times 1.5. And we see the pertinent number of qualifying stocks on the lower chart. While I'm realizing that the numbers are really too small for any one of us to read, what we can clearly see, and that's the main point here, is the numbers vary over time. Because while median ties to a percentile of the market, 1.5 times median doesn't. Yet, what you can do is you can find a percentile that's not too funky in the sense we're not doing any data mining here. We're just looking for an intuitive threshold, which ties both to median. It's actually 1.5 times 50% is 75%, so why not look at the 75th percentile? And that actually yields you a yield threshold for your universe that's very similar to 1.5 times median, while having the big advantage of having a stable number of components in your base universe, which is a very nice feature and something that makes a lot of sense using in this case. But the big point here is there's no real right or wrong solution. It all depends on the client and what they want. A comment that we could have made here, for instance, is we're looking at the European universe. In using a fixed yield threshold, we're implying either one or two things, which is that we're assuming that interest rate levels will stay similar across European currencies now and in the future, or that we're completely comfortable taking a bias towards higher yielding currencies within our portfolios. That was the case in our case, but it's a discussion worth having, especially if you're investing in a global portfolio. Or if you did the same thing in developed Asia and used a fixed yield hurdle instead of a flexible one, you'd probably end up with a portfolio strongly tilted to Australia and the higher yielding countries.
So in the end, the client appreciated the consultative aspect and the thoroughness of the research around various ways to embody their yield screen. They ended up going with the 75th percentile, so they actually did slightly change and modify what they were doing internally and actively, but they did appreciate what we did and how we looked at it and how the index provider was able to give some level of choice. But I think that's what's important is not only when you're creating a smart beta product, but as an investor, as you're evaluating smart beta products, to understand what are the inputs that go in and how does that affect your behavior and that product or that strategy's behavior over time. And that could be, does a simple screen change the constituents? And what do those bad times look like? So those times when you have higher concentration, the times when you may have more drawdown, or you might be a bit more uncomfortable in this style of strategy. So just like building a strategy, the things that go in also need to be then evaluated by investors as they're trying to balance what makes the most sense and how do I best use it. And so that you can then understand it, but then you can explain it whether it's to a board or whether it's to an end investor.
So far we know that that the top 25% highest yielding stocks out of Europe 600 qualified. The next thing we needed to do was introduce a value and a quality tilt. The way the active managers were targeting to replace here did it was they introduced a screen only allowing companies with below market P and PB to pass the screen, and only companies with above average return on equity to equally pass that screen. Now, while I'm not going to go into the logic here to bore you with pretty much the same logic that we just discussed for the yield, the questions that I would like to throw in here in the discussions that we're having as we're talking to clients are the following. One is, when we're looking at ratios that tie to balance sheet numbers, they tend to be very volatile. Yield is probably the least volatile one of them because companies target a certain yield level, and dividend yield level, and they want to see that policy change too dramatically because investors don't like that. Yet these other ratios that we're talking about, ROE, price to book, price earnings, tend to be very volatile. And if you want to introduce a level of stability, both in the sense that you want to reduce turnover and ultimately costs of your investment, and that you also want to take a look at persistence of these features in your portfolio. Mr. Sakamaki earlier today talked about how the persistent track record of high ROEs is very important to the design of the Japanese quality strategy. That's something that we strongly recommend. Looking at least considering, and we have these discussions with clients to see what type of moving average here is the right choice for them. The second thing is, we're saying here we're introducing a quality tilt, right? Now, quality is one of these factors that we've already seen it throughout this conference. We all tend to have quite different definitions. It's not something that's very standardized in the market. And as we're replicating a given strategy by an active manager, we do enter discussions with clients to make sure that we also understand what their philosophy is and make sure that this is actually matched in the algorithm that we're using. So is there a consistency versus the rest of the ETF toolkit is a question we're having that may or may not be desired, but it's certainly a discussion worth having.
So liquidity, an important component when you think about an ETF. I mean, it's essentially the essence of an ETF is being able to get a liquid exposure. So did the client do anything when they were thinking about liquidity? And reality is they weren't concerned. They were using an extremely large and liquid universe. So they weren't uncomfortable with not having a specific liquidity screen. But I do think it's worth highlighting, as an ETF provider, what do we evaluate when we're building a new strategy to make sure that it's liquid for our investors? And that's not just liquid as an ETF trades, but also liquid in the underlying. So also it's important to think about capacity. So how many securities do you have? If you get in the fixed income space, especially if you get to high yield or various versions of credit, there can be potential capacity challenges. Or if you get into more esoteric or exotic markets, there's capacity issues. So it is something that we think about when we're launching and we're designing a product. Turnover. So what is the turnover amount? And how does that impact cost? And does that mean that it's challenging to track an index if turnover is quite high? And we also stress liquidations. So if we were to sell $2 billion today in a European momentum factor product, how much would that cost? So we would do the same thing with every strategy we launch. Our risk team within BlackRock ensures that how many days would it take to sell? How much does it cost to sell? And this is at very large amounts, 2 billion, 5 billion, 10 billion in assets. And then we think about optimizations. So are we going to fully replicate the index? Do we have local access to India? Do we have local access to Colombian bonds? So we're thinking about, do we want to optimize the product, or do we want to fully replicate the product? And what is the trade-off? The trade-off being cost, the trade-off being tracking, and that ultimately being the investor experience. And then lastly is frequency of rebalancing. So something that came up again a few times yesterday is how frequent do you rebalance, and what are the costs and the governance structure that goes into that? So is it a monthly basis, semi-annually? And how does that, again, impact the investor experience?
So with the discussion of the review scheme, the rebalancing scheme already approaching oftentimes one of the last questions in the original go-around to define the strategy algorithm is the weighting scheme. So the reference point here, once again, was cap weighting, and the goal was to have a tracking error of maximum 8%, which in a broadly diversified universe that's cap weighted is actually not that hard to achieve. So as we are looking at how we're going to replicate that, one is certainly we already know we have cap weighting. That's very straightforward to implement. The next question we have is how do we implement the rebalance, meaning the reweighting of the components without actually rerunning the universe selection within the algorithm, and how we're going to run the review. Now, in our case, where we're looking at a lot of balance sheet related items here for a European strategy, with a lot of dividends, with a lot of annual reports in Europe typically coming out in the second quarter, a natural approach would be to have a September review. And throughout the year, where you're really not having a lot of new signals coming in, just doing a regular rebalance, typically around the quarterly period, is something that makes a lot of sense to limit turnover. But you could also consider different approaches. For instance, it may, for practical purposes, be easier for some reason for the implementing asset manager to maybe have this coincidental or not with the rest of the portfolio. That may be a consideration worth looking at. And we earlier today talked about everybody looking at monetary policy out there. So one reproach that passive strategies get a lot is that, hey, you guys, you're not really reacting to those types of movements in the market as much as an active manager can. A rules-based strategy is by no means restricted from also taking in macroeconomic or whatever signals you want to define to trigger a new review or rebalance. So it's a discussion worth having with the client if such events should be considered in the review process. What we went here for is cap weighting with annual review in September and quarterly rebalancing. Now, we're getting back here to the picture of the recipe and the whole Lebkuchenherz picture here. The reason being that just like when you're baking something, when you're putting together a recipe, it's not necessarily first go around that you just follow your recipe that made sense to you, and then it's going to be perfect. You will very importantly have to taste what you're getting here in terms of output. So The sheer fact that the methodology is in line with the active managers that you're targeting to replace is certainly a necessary condition in terms of meeting the client's needs. We're also taking a look at the risk-return profile, if that is what was requested. And we go a step deeper, which is are the factor loads consistent with what the client wanted to achieve? Even in cases where the client may not actually be looking at that himself or may not have had that habit in the past, it's truly helpful to understand what your return drivers are. So, for instance, if you took a very high threshold in terms of the yield that you're requiring or the value and the quality tilts you're requiring, you might end up with a rather concentrated portfolio, and you may think that it's a very high yield portfolio, but really what you're having is a lot of idiosyncratic risk, more than you would actually want. So looking at factor loads is important, and keep in mind that's another discussion we had earlier today and that Mr. Sakamaki touched upon, that as you're looking to verify your factor loads, you may be facing different descriptors for your different quality factors. So how do you ensure that you really meet your quality exposure that you're wanting if maybe your risk model has a slightly different description of quality than your model has? It's something that there's no good answer, there's no fixed answer to that. It's something that's found out in the discussion with the client.
Right. So,
adding to that maybe is the complementarity and the fit with the rest of the portfolio was, especially in this case, very important as we're looking for a strategy to complement an existing toolkit of ETFs. So it's not something, unlike sometimes we have cases where clients truly want to look at a strategy standalone, and that's maybe more of a satellite in a core satellite approach. Here we were looking at a case where the strategy needed to fit with the other pieces of the toolkit. The last point here that we're showing, are the components intuitive, is something that can be a tricky one. So even if you're passing all the screens, so you have your strategy, methodology is right, factor loads are perfect, everybody's happy. And then all of a sudden your largest component is somebody who maybe is in breach of United Nations Global Compact principles. All of a sudden you realize that maybe in the very beginning some of the requirements weren't as fully defined as we should have defined them. And that's where we get back to the recipe analogy. Sometimes you have to start over, add a couple more ingredients, change the mix, and only then you get to the perfect outcome.
Right. So there's a few takeaways we can see from developing a strategy. So one, if you have an idea and you're trying to embody something within your portfolio already, work with an index provider, work with an ETF provider or an asset manager to see, is there something that exists that can make my life less cumbersome, make things easier, and can it be done through a rules-based and transparent strategy? I think a more important concept as we're going through this is not only how is a strategy built, bespoke or custom for a client, but how do you perform due diligence on smart beta? And I think that's a really important concept in today's market is, what components of my active manager research and what components of traditional index research do I need to build into my process so I can ask questions of why and how. So you need to know why were the inputs put in and how does that affect your experience. And so knowing how things behaved historically and being able to project how they'll behave in the future will give you a more transparent understanding of what that strategy is intended to accomplish. So that's looking at factor-based loadings, that's looking at holdings and constituents, that's looking at any intentional risks that you may take. So that could be at the sector level. That could be through max drawdown. So it's very different than just looking at a plain vanilla index. And that's where I challenge investors is you need a healthy amount of skepticism when it comes to smart beta. You need to understand, is it fit for purpose? Does it work within my portfolio? And what are the risks? So not only please come to us when you have questions on launching something, but also work internally and work with providers and challenge them to explain why is something built a certain way and how will it affect you. Excellent. Great. So if there's, I don't know if we have a minute or two for questions. If not, we can answer them at the end.
I think we'll address the questions in the round table at the end.
Perfect.
Because, we extended the time, but thanks very much.
Sounds great.